what's going to happen here is one of three different things. So either the union is going to succumb and go closer to the employer demands, employers are going to succumb and go closer to the union demands, or they're going to meet somewhere in the middle. What's up, apes? Welcome back to the 𝗟𝗚𝗚𝗚's daily podcast of the day. Thank you all for joining us here once again on this beautiful Thursday, October 3rd, 2024. It is currently 6:29 p.m. and there's a lot going on in the world that could impact your bank account. So stick around and we'll make sure that you're aware of it all and everything that mattered here today. Some interesting stuff going on. First of all, these fucking longshoremen that are striking. It really has been worse for my mental health than that time that my therapist dropped me as a client. Not even lying about that. So something's got to break. Something's got to give within that part of the economy because, as we'll talk about in a couple of minutes, it is really going to screw things up if this thing lasts any longer than, if it goes longer than finishing yesterday. This is going to be a huge problem for the U.S. economy. So we'll break down exactly what that means for you and your produce in addition to your wallet. So stick around for a couple of minutes and we'll be talking about that. We'll then get into some of the biggest stock movers of the day. We had some companies blow up and others completely fall apart. It was a busy day in capital markets here on Thursday. Finally, OpenAI just got a whole lot weirder with its valuation, its funding, and we have a whole lot of questions. So maybe you can help us answer those, but stick around and you'll find out. Before we get into all that stuff, we got to talk about some of these banana bits. But before we get into the banana bits, we got to talk about the WSO Alpha portfolio. So not gonna lie, rough day for the Alpha portfolio. Once again, we were down about 30 basis points on the session here today. Now, if I'm being honest, it was a pretty rough day for the entirety of the market. Now, it was a particularly rough day for Alpha compared to the portfolios we actually care about. So specifically, the NASDAQ lost about 4 basis points on the session. The S&P lost 17 basis points on the session. The Russell was down 67 basis points, and not that anybody cares, but the Dow was down 44 basis points. NVIDIA led the way for us up 3.37%, but we had some real stinkers in the portfolio here today, specifically Constellation Brands and Tesla, really killing the vibe for us, so that's kind of why we underperformed the market today. But anyway, we're up 11.7% on the year so far. I'm going to pretend that I didn't just say that, and I'm going to go ahead and move on before I fire all of the analysts on the team once again. Let's go ahead and get into some of these banana bits. So first and foremost, CNBC did a great job rounding up everything that's going to be important for the jobs report that's coming out tomorrow. We do have a huge jobs report, well, really this morning, that's going to be dropping probably earlier today by the time that you're seeing or watching this. CNBC is getting you prepared for everything to expect when that report comes. Meanwhile, oil prices absolutely skyrocketed again here today. We talked about this pretty recently, what was going on and the demand threats and everything like that. And now those threats are actually starting to materialize. So it's becoming a huge concern for producers in the Middle East, but producers here in the United States absolutely love a higher international price of oil. Now, at the same time, what we also saw here earlier today is that the Biden administration did just get some federal court approval to move forward with its student debt cancellation program. So it's going to be very interesting to see how that plays out and how fucking pissed off all these boomers get about that shit. Quite honestly, I'm pissed off about it too, to be honest with you. But either way, the Biden admin looks like they're going to be closer to paying off everybody's student debt in a short time. Sherwood News, they're out here doing the Lord's work, thankfully, as always. And specifically today, what they did in service of every American, really everybody on the planet here today, we should really all be thanking them for this. They went ahead and they ranked fast food drive-thrus by their timeliness and their accuracy. It goes without saying that they're all complete trash, but you can go in there and check out which one's the least shitty. Spoiler alert, it is McDonald's. Moving on down below, SoFi, my bank, my personal endorsement, love SoFi, check that shit out. But they went ahead and just launched a platform that's making it easier for retail customers to get access to IPO shares, and it even makes it easier for companies to give retail investors access to those IPO shares as well, so they don't have to go through in these fucking roundabout methods like Robinhood did to give to its platform users, like Reddit did to give to its top 50 users on Reddit or whatever it was. SoFi is making that process a whole lot more easy. Finally, the Bank of England thinks that they're fucking cool or something like that, coming out here shitting on the United States, even though we beat the hell out of them in 1776 and continue to beat the shit out of them every day since then. The Bank of England is still coming out here saying that they are concerned about future stress due to shorts on U.S. debt. Well, England, you guys would be fucked too if it wasn't us, so maybe get off your high horse a little bit there. Either way, let's go ahead and get into our big macro monkey major story of the day. We are, of course, talking about Give Me Banana. This is probably my favorite macro monkey that I've written in quite a long time, but we really do have to do something about this here today. This is a call to action for all of you apes out there. Gas up your cars. We are heading to the docks. Everybody's driving out to the East Coast, and not just to take advantage on the beautiful scenery that you can find on the interstate highway system, the eighth wonder of the world, if you ask me. But we are going out there because these dock workers that are on strike, they're trying to destroy your beautiful economy and eviscerate all of the shareholder value that you create on a daily basis. I won't stand for it. This is absolutely ridiculous. But before we get in our cars, we don't want to be watching videos and driving or anything like that. So let's go ahead and understand exactly why this is going to fuck over the U.S. economy. So as we speak, 45,000 members of the International Longshoremen Association, the largest dock workers union in North America, are currently on strike. According to JP Morgan estimates, this is costing the U.S. economy already anywhere between $3.8 and $4.5 billion per day in GDP. Now, Oxford Economics, they went about their estimate a little bit differently, and they said the estimated impact is worth about 0.1% of annualized GDP for every week that the strike continues. So this is having a huge impact, billions of dollars worth of impact. And I mean, it's been, what's today? Thursday, so it's been 4 days already. This could be anywhere between $15 to $20 billion that it's already cost the U.S. economy. That could have been shareholder value that you created that is now getting eviscerated. Like, I would be pissed if I was you in that situation. Specifically, the products that are most at risk include agricultural products. Now, roughly 72% of U.S. waterborne agricultural imports come through the East Coast, and specifically the 36 ports that are all currently shut down by these striking dock workers. So, waterborne agricultural imports, that's just a smart word for food that comes in off container ships. That's really all they're talking about right here. New York alone is responsible for about 22% of that. Philadelphia at 8%, and Boston at about 6% or so. So that's what, about 36% just from the 3 ports alone being shut down. So these lazy fucks, I'm only an hour and a half away from you fucks that are protesting out in Boston. You better hope I don't come out there with these hands. You guys, I mean, I'll throw hands with anybody, and you guys will probably beat the shit out of me because you're dock workers out there loading and unloading container ships, and I sit here and press buttons on a computer all day, but still, I want all the smoke, so I'll come out there. Please just don't beat me up too badly. Either way, without these dock workers there to load and unload these cargo ships, a queue has already been starting to form. Now, outside of the New York, New Jersey port, there were 45 vessels as of yesterday morning that were known to have anchored at these ports. Now, the products in these ships, some of them, doesn't really matter how long they sit there. It's like automotive parts, apparel, electronics, other shit like that. But the really bad part is what we just mentioned, agricultural imports. Most of these are perishable items, and they have a certain shelf life. And correct me if I'm wrong if we have any biologists out there, but sitting in a fucking container ship isn't great for bananas, specifically bananas. And this is a huge problem. This is the reason that I was fired up here today, because if you know me, you know I'm a guy that loves bananas. And no, I don't mean that in any euphemistic way, so I can already see you guys in the comments there. No, that's not what we mean over here. But what I do mean is that 75% of bananas consumed in the United States are imported through ports managed by the International Longshoremen's Association. So obviously, bananas don't grow naturally in the United States. We import just about all of these. And in fact, we import over 60% of all of the fruit that we consume in the United States. And most of that is coming through these Eastern Coast ports that are controlled by the International Longshoremen Association. So basically, we're going to have a 75% reduction in bananas if this doesn't get fixed relatively soon. If we go ahead and take a look at some of this other stuff, 90% of the imported cherries, so this isn't all cherries, this is just cherries that are imported, where we were talking about all bananas, but 90% of cherries that are imported come through U.S. ports, 85% of canned goods, 82% of hot peppers, and even 80% of chocolate. So, Jesus Christ, if you like chocolate and bananas, which if you almost definitely do if you're watching this video right here, we're a fucking monkey-themed company, like, give me a break, then we're going to be in big trouble. So, this is definitely not something that we necessarily appreciate seeing, now especially on the agricultural product side there because of how perishable this stuff is, but it actually gets even worse, if you can believe it. As much as we love bananas, everybody knows we love our beer even more, obviously. More than 80% of beer, wine, whiskey, and scotch that is imported to the United States, again, not all, but just that is imported, comes through currently shut down ports that are managed by the International Longshoremen's Association. Now, arguably, this makes the ILA in the same league as ISIS, Al-Qaeda. Who else is up there? The CCP, like, Jesus Christ, just want to, Greta Thunberg, some of the worst organizations, the most anti-American organizations out there, because holy shit, if you're giving us a 60% reduction in fruit, a 75% reduction in bananas, and an 80% reduction in my fucking Jameson, then we're going to have a real problem on our hands. But if that's not frustrating enough, just wait a second, because when you find out why these dock workers are on strike, you're going to start punching your screen. And please don't punch me in the face or break your screen or anything, but just a fair warning as we get into this. So, When we're looking at these, at what the ILA is specifically demanding, it involves basically two things. One, a 77% wage increase. This would be the largest, by far, largest increase in the union's history. The second largest is 40%, so this is nearly doubling that increase that they've gotten. So they're looking for a 77% increase in wages. Specifically, they want to bring up the minimum wage for ILA dock workers from its current $39 per hour right now to a very, very nice $69 per hour, and that's how you get that 77% increase in wages. The other part of what they're asking for is a ban on just about all automation, especially things like cranes, trucks, and gates that require a lot of human labor right now, but could absolutely be automated away in a heartbeat. So, before we talk about the automation side of things, I want to focus in on the earnings, because the Wall Street Journal published a piece yesterday talking about the earnings of these dock workers. So first and foremost, it's very hard data to ascertain because the Waterfront Commission that used to kind of aggregate all of this data was dissolved in 2023. So we don't have access to any of this information anymore. The most up-to-date information and the most accurate information that we have for ILA employee wages is from a 2019 to 2020 database that shows the earnings ranges for longshore workers. Excuse me, I'm choking on my own spit again over here. Earnings ranges for longshore workers handling deep sea cargo vessels at the port of New York and New Jersey. So that is specifically what we're talking about here. It's a very specific thing. It's a little bit over 3,600 employees, so we can kind of generalize this to the entire ILA or the entire union itself. But keep in mind, this is New York and New Jersey, so it's probably the highest earners, but at the same time, this is also 4 or 5 years ago. So this is probably a pretty good estimate of what the entirety of them earn. So if we look at this chart right here, you can see the chart yourself, but I'm going to break down the 3 biggest takeaways from this chart. Over 82% of workers in the International Longshoremen's Association earn more than the median American salary of $59,436, according to the Bureau of Economic Analysis. So it's not like these guys are getting underpaid or anything. They're making a ton of money already. Secondly, the wage cohort with the most employees, so which band of incomes, and they do it over basically just like $50,000 degrees. The band of incomes that has the most people in this group right here is the income range that is between 150,000 and 200,000. So that's the mode of this data set right here, is between 150 and 200,000. Absolutely ridiculous to expect that. But that's what most of these people are earning, or that's kind of like I said, it's the mode of the data set that we're looking at here. Finally, over half of the ILA members earn more than $150,000 per year, and over 3/4 earn above $100,000 per year. So these guys are honestly killing it. They're making a fucking ton of money, and they're out here demanding nearly doubling that salary up to like the 77% wage increase. Now, this is also coming with that automation side of things. So what I think is most likely to play out is, they'll be on strike for the next couple of weeks here. Eventually, we're going to have to come to some kind of conclusion, because the U.S. economy is going to be getting fucked over. Biden, it's an election year, might have to step in and ultimately kind of break the strike, at least through election day. Wouldn't be surprised if that was an outcome. But overall, what's going to happen here is one of 3 different things. So either the union is going to succumb and go closer to the employer demands, employers are going to succumb and go closer to the union demands, or they're going to meet somewhere in the middle. So either way, the agreement that I personally think option number 3 is going to be more likely. I think they're going to meet somewhere in the middle, and that outcome is going to have one of 2 possibilities. So either they'll get the 77% wage increase without a full automation ban, or secondly, they will get a lower wage growth with a much stronger, much more robust ban on automation. So we'll see which one of those comes into fruition, but that's my guess as to what's going to actually go on here. This is completely ridiculous to expect that there's going to be no automation in the dock worker sector going forward. However, this is just 100% guaranteed that's going to happen. You're fighting technology, you're fighting progress itself, and it's just not necessarily a battle that's really worth fighting for. Like, imagine if you were you're a blacksmith in England in 1753, and all of a sudden they start coming up with these machines that are producing these things way stronger, way faster than you can. And you go out there and try to lobby so that these things get banned, or you form a union so that you can ban your employer from doing so. Yeah. Not going to happen. Absolutely no way that this goes into long-term effect, but it'll be interesting to see if it can be like a band-aid over a bullet hole thing to resolve this ongoing strike. All right, that about does it for us with the Macro Monkey story of the day. Let's go ahead and move on into some of these stock movers. First and foremost, we have EVgo. This is an electric vehicle charging company that you probably haven't heard of before, but I'm sure you're going to want to hear about it today because shares were up 60.81%. Absolutely ridiculous returns from EVgo. This is huge news. The company got a $1 billion line of financing from the Department of Energy. Now, the reason for that is because EVgo is pretty cash strapped, but they are still trying to build out these, this electric vehicle charging network. So effectively, they just got $1 billion to build out more EV chargers that will inevitably only add to the growing trash heap that's filling up our ocean. So, long term, probably not really going to do too much here, but this is probably part of the current administration's vendetta against Tesla. Now, it's pretty clear that everybody is moving towards the Tesla standard of charging. There was actually a piece in Sherwood today as well talking about how charging is the biggest blockage to mass adoption of electric vehicles in the United States. If you really wanted to encourage this adoption, you would have one charging standard and then just encourage all of the EV makers to go by that standard. And that's basically what's happening by the forces of the invisible hand. Shout out to Adam Smith already. But it seems like the Biden administration doesn't necessarily want Tesla to kind of have control of this. These are pure allegations. I haven't seen any data about this at all, but kind of thinking back to when they had the EV summit and they invited like GM and Ford, but they didn't invite Tesla. What the fuck? So it could be something related to that, but you never really know. Either way, all these chargers are going to end up fucking probably choking some whale at some point anyway. So, RIP to that whale in advance. Moving on, we have NVIDIA up next. Shares were up 3.32% for the session here today, and they must be so thankful that they have CEO Jensen Huang. And Jensen Huang, he must be thankful that he's been in this position as the leader of NVIDIA, but if his business career doesn't work out, sometimes it's on kind of shaky ground. He's only worth like $105 billion or something like that. So if his career as the CEO of NVIDIA doesn't work out, this guy absolutely has career prospects in the entertainment business, and specifically as a hype man for almost anybody that will have him. He put those hype abilities on full display Wednesday evening on CNBC's Closing Bell segment, where he confirmed that demand for their latest Blackwell chips is quote-unquote insane. So that got markets pretty fired up because people were a little bit hesitant over like if Blackwell was kind of like too advanced for the times right now. Absolutely not the case whatsoever. He also confirmed that Blackwell production is currently up to full swing. It's kind of at its full scale right now. So when it launches, when it becomes available for sale in the fourth quarter, companies are expecting huge demand and enormous additions to NVIDIA's top-line revenue growth. Now, TSMC shares were up a good bit as well because TSMC is the contract manufacturer for NVIDIA. Let me check. I didn't see what TSMC shares finished up for the day. You know what's really annoying is everybody calls this company TSMC, but their ticker symbol is just TSM. Like, I wish they would just add that C on the New York Stock Exchange. But yeah, shares were up 2.12% on the day. Is there a TSMC ticker out there? Let's see. No, there's not. It just brings me back to Taiwan Semi, so I would assume that they could do. They really should do that. That would help me out quite a bit, and I would definitely appreciate that because it would simplify how the fuck to talk about this company. But let's go ahead and move on into some of our stinky rotten movers of the day. First and foremost, we have Levi Strauss. Now, Levi Strauss had a solid quarter for most of its business. Notably, there was one segment that kind of killed the entire vibe. So, shares were down about 7.69% on the day. Not a nice 7.69% this time, because the company's earnings report, like I said, came in strong in some parts and very, very weak in other parts. Right now, as it relates to denim and kind of apparel entirely, Gen Z is kind of in this like desperately sad attempt to revive the counterculture revolutionary vibe of the 1960s and 70s. So denim has become cool again. Denim jackets, all denim outfits and all that shit. That's been great for Levi Strauss. They saw a 5% sales increase in their Levi denim brand, which is the fastest that they've seen in the past 2 years in the last quarter. But unfortunately, that didn't help because there was a 15% year-over-year decline in the khaki sales at the company's Dockers business. Now, they launched their Dockers brand because before Gen Z had money of its own, nobody was buying blue jeans anymore because they were considered like old school. And now Gen Z thinks old school shit is cool, so they're kind of all over it. But at the time, Levi was kind of trying to diversify its brand away from just jeans. So they bought Dockers, they launched Dockers, they started this khaki brand, and now they're getting completely fucked over. Sales down 50% year over year, but Beyond Yoga sales surged 19% for the year, so that kind of helped out as well. The company did beat on earnings, but it missed on its sales estimates. So once again, shares down 7.69% on the day. Finally, we have Hims and Hers. Now, this is a healthcare company that you probably haven't heard of unless you have ED or something like that, because I think they're big in that space. But either way, the company was down 9.60% on the day. I didn't realize that. I'm going to have to switch around these names right here because Hims was actually ended the day down even further than Levi. I don't have to switch this while I'm talking to you guys, I guess. But still, shares down 9.6% on the day because turns out Ozempic works far too well. Only the thing is, on Thursday, Ozempic was reducing the size of Hims's market cap rather than their waistline, which I'm sure they don't appreciate, but it was all thanks to the FDA and Eli Lilly. Those two are like, if Eli Lilly and the FDA were people, they'd be like fucking Jim and Pam. They are the cutest couple, certainly one that we can all get behind. Eli Lilly, this is the world's largest healthcare company, or the world's most valuable healthcare company, and they officially just got their GLP-1 products removed from the FDA's shortage list. So what was going on here? Well, Eli Lilly's version of Ozempic, it's called Mounjaro, and it was on the FDA's shortage list. Now, when you're on the FDA's shortage list and you're a crucial medicine like this was determined to be, then other companies are allowed, while your drugs are in shortage, while your version of the product is in shortage, other companies are allowed to produce kind of just carbon copy versions of that and sell them on store shelves so that demand is met. Hims was all over this. They hopped on that train. They pumped out as many of those GLP-1s as they possibly could, meat riding the industry's biggest success in decades to do so. Now it's illegal for them to do that once again, so shares are down more than 10 or almost 10% on the day. All right, moving down into our Thought Banana session. We're going to finish things up here today. We are talking about management out and money in. Now, most of the time, most executives and company managers I know, all they care about is exactly that, just kind of increasing their budget for the year. So it's a little bit weird, the dynamics that we're seeing ongoing at OpenAI. So OpenAI, it's not hard to understand why investors want a piece of this company. They're easily the most innovative company of this, arguably of this century so far, and certainly over the past couple of years. They created the AI space. They established this narrative and arguable bubble in markets when ChatGPT burst onto the scene back in late 2022. So it's a little bit weird as to why we've seen a lot of executive flight out of the company right now. Like, I'm sure a lot of you have seen the kind of memes going around. There was that OG image of Sam Altman, Ilya Sutskever, Greg Brockman, and 𝗪𝗻𝗻𝗏 that were like sitting in a room trying to look tough and cool, which is absolutely impossible for techno people. But they still gave it a shot, and there's four of them staring very intensely at the camera as they're plotting to take over the world with their AI bots. Now, there's only one person in that image that's remaining, and that is Sam Altman. Greg Brockman left in October, Ilya left back in May, and as of earlier this week, 𝗪𝗻𝗻𝗏 has also exited the firm as well. Really, really weird when we consider some of the context of OpenAI, because at the same time, it was just announced today that the firm, has officially closed its latest funding round. They amassed a total of $10.6 billion in liquidity. Like, it'd be understanding if these executives were like, all right, we got to get out of here because we're not getting any money to do any of this shit. No, you have $10.6 billion, and specifically $6 billion or $6.6 billion of that is coming from equity investors. These are being led by Thrive Capital. It includes other VC firms like Altimeter, SoftBank, and a whole bunch of others, but it also includes other companies like Fidelity, Nvidia, and of course Daddy Microsoft, who owns half the company. They gave about $6.6 billion into the firm in total. Now, they did so at a $157 billion valuation for the company. We talked about this yesterday, but I put together this chart just to show how ridiculous that is. That puts OpenAI right in between the values of AT&T and Goldman Sachs, relatively in the neighborhood of companies ranging from Disney all the way down to Lockheed Martin. Yes, OpenAI is officially about $14 billion more valuable than Lockheed Martin as of yesterday's close. Completely ridiculous to think about. They're the size of CVS and Airbnb combined, as another reference. So kind of ridiculous right there. So in addition to that $6.6 billion in equity capital that they got, they also got a $4 billion line of credit at a rate of SOFR plus 1% from a consortium of the largest banks in the Western Hemisphere, companies like JP Morgan, Morgan Stanley, UBS, basically every company that you want to work for, quite honestly, invested in this line of credit right here. They all wanted in. This investment very much is carrying hardcore, like this time it's different kind of vibes, because artificial intelligence is a brand new technology. OpenAI, clearly a hyper successful company from it, but are they successful enough to justify this valuation? Well, let's talk about it. So the company will generate $3.7 billion in 2024, according to estimates from CNBC that they quote-unquote confirmed. Don't know who they confirmed it with, but they said that the company pulled about $300 million in sales in August, and I think they just annualized that and threw on a little bit extra to call it $3.7 billion. But that's the only information we have, so we'll go with it. Now, at the same time, they also plan to lose 135% of their revenue, or $5 billion in total, on the bottom line. So they're going to eviscerate just about all of that, hence why they needed a $10.6 billion check. But at the same time, the company expects to earn about $11.6 billion in sales next year. So with all of that stuff in mind, this means that OpenAI just got valued at a 42.4x current revenue multiple. So that is current year revenue multiple. Basically, the company is valued at 42.4 times the current year's revenue projection. So just for context, the median in the software as a service, aka SaaS business, right now is somewhere around 4.1x. Now, this changes quite a lot with time. In late 2020, 2021, that was much higher. It was more like 8x. In, horrific periods like in 2008, it's much lower. So it fluctuates with liquidity over time. That's basically what it fluctuates on. So once again, this company is seeing valuations somewhere between, 7 and 10 times the industry average, at least if we look at the current year multiple. Now, if we go off of next year's multiple, then it's a much more reasonable 13.53x. Much, much more reasonable, because in the past, during boom periods like 2020 and 2021, the fastest growing companies were able to drive sometimes 20x revenue multiples. And so what these companies actually determine these multiples based on, in addition to just market conditions, is basically two fundamental line items that the company is reporting: annual recurring revenue and net retention rate. So we already talked about annual recurring revenue and the multiple that's going to get slapped on that. Net retention rate is how much of that revenue gets rolled over into next year. Basically, you want a high percentage of subscription revenue so that it can get rolled over. And then your metric can go over 100% by just adding new customers. That's really how this metric works right here. So if we assume that all of OpenAI's revenue is recurring, it's not, but it's probably somewhere north of 90% or so. So if we assume that all of it is recurring, this company is expected to have a net retention rate of about 313.51%. Now, if we assume a 90% ARR, or 90% NRR, this is a 15x multiple for next year. So again, right within that ballpark for hyper-growing companies, which starts to make sense once again. But once we realize that the valuation actually does make sense in a certain context, it only becomes weirder why these executives are leaving. I can understand wanting to leave because, oh my God, we just set such a high hurdle rate on ourselves to get liquidity for our investors. We're never going to be able to reach that. Let's go ahead and get the hell out of here. But this is pretty reasonable if next year's projections are to be believed. So why are all of the executives leaving? And it's not just at the executive level. We're seeing a bunch of, lower level employees leaving as well. If you are the most valuable startup in the world, if you're creating the most advanced technology in the world, what else would you want to do? All of them, when they leave, they say that they want to explore new areas, pursue passions, or some other fucking quote that you would find on the kitchen wall of a sorority house is basically the reasons that they're all leaving. Why would you want to do that if you're building the coolest shit already at OpenAI and you're probably making a ton of money because everybody wants a piece of your company? There's no reason at all to leave. Now, we know that Ilya had beef with Sam, so that was kind of the biggest reason there. He went ahead and started his own AI company. I was super worried. I thought it was going to be a dangerous AI company, but apparently it's called Safe Super Intelligence. So that assuaged my concerns right there. If you're calling something safe, if you have to call it safe, then it must be, because otherwise, why would you do it? So he went and started Safe Super Intelligence. Maybe these others are kind of planning a transition over into that company, but otherwise, I really have no idea what's going on in OpenAI. Financially, they're doing great, but with their human capital, certainly need some improvement. So, Jesus, we're almost at 28 minutes. Holy fuck. Let's go ahead and leave you with a quote from the CEO himself, Mr. Sam Altman. I want to inspire you apes this beautiful Friday morning, and Sam Altman is getting the job done right here when he said, "The only thing worse than starting something and failing is not starting something." So go ahead and start a riot if you want to. Even if it fails, who cares? At least you started something, right? I'm pretty sure that's the takeaway from that quote. But either way, shoot me a message. Let me know what you guys think about everything that we're talking about here. David@wallstreetoasis.com. Always love seeing emails from you guys, and I would love to see some more come across my way as well. For now, have a wonderful day. Close out the week well. Don't blow yourself up heading into the weekend. Have a wonderful weekend at that, and we'll see you soon. Happy investing and happy trading. Bye now.